Hello, this is Jordan, and this video is being recorded on the afternoon of Wednesday, April 7th, 2021. Thank you so much for joining me today. If you're watching this on YouTube, please like, comment, and subscribe if you haven't already done so. Thank you. And in this video, I will discuss a key event which could trigger or confirm the next launch point in gold. So I'm showing one chart here, and there are more than a few things in this chart I want to discuss. But that next event is essentially when the Fed starts hiking interest rates. Now, let me explain this chart. At the top, you have the Fed funds rate. Below that, you have the 2-year yield, which is a proxy for the Fed funds rate, sometimes a leading indicator of sorts for the Fed funds rate. The Fed tends to follow the 2-year. So when the 2-year starts moving up from a point where they haven't been hiking rates, that can lead into the Fed changing policy. And at the same time, when the 2-year starts turning down, and this happened in 2018, late 2018 and into 2019, the Fed, after hiking rates, then will have to cut rates. So that's why the 2-year is important. And then at the bottom there, taking up most of the chart, that is gold. And also in the chart, we have a couple of C's. You can see the C's. One is there, I think, beginning of 2001, another one in 2007, then another one in 2018. And those are the points when the Fed cut rates for the first time in a while. That last C should be in 2019, but so it's a little bit before that point. But anyway, I wanted to mark because there can be the Fed cutting rates and then also the Fed raising rates. They both can be an important catalyst, and I'll explain why. More so on the hiking side, because we haven't seen that in a really long time. We did see that at the end of 2015, but it was really short-lived. I mean, gold had a big move in 2016, then it went sideways for 2 years before breaking out, even as the Fed was hiking rates. So here on this chart, the vertical lines, they mark not every low in the gold market, but some important lows in the gold market. And also there's one that I have in red in 1985. But basically all those lows, except the one in 1985, those were around points which the Fed began a new cycle of hiking rates. And so look at the last 3 times the Fed began a new hiking cycle. You have the end of 2015, that was an important low in the market. You have 2004, and that was also a somewhat significant low in the gold market, not as significant as 2008 or 2001. And then you also have 1999, which in terms of price, that was the low in gold after the secular bear market. So those are the last 3 points when the Fed began hiking rates. And of course, if you go back to the 70s, gold really exploded after the Fed started hiking rates at 2 different times. So now this seems counterintuitive, but the reason why the Fed beginning a new hiking cycle is very bullish for gold is because it signals that inflation is taking off or accelerating or moving higher and really gaining traction. Now, the Fed is always behind the curve. Other than when they started hiking rates at the end of the 70s, that's the only time the Fed was ahead of the curve, and the only time when the Fed was hiking and real interest rates really increased because of their hiking. Basically, every other time the Fed hiked in a way where they would kind of they wouldn't be that focused on really stopping inflation. It was more like, okay, we just need to, we can't stay that far behind the curve. We have to hike here a few times. So for the most part, and historically, the reason why bottoms in gold can coincide with the Fed beginning a new cycle of rate hikes is because it's a signal that inflation is starting to take off and it's starting to accelerate. And so the reason why that will be true again this time around, I mean, assuming the economy gains a lot of traction, the data comes in red hot, and that continues past this year and into next year. I mean, there's a lot of money coming into the economy, and things are going to be looking better. You know, the banks are probably going to lend a lot more than the market is thinking right now when they see all these numbers coming in. You know, people are going to be more optimistic. So all these things could be happening over the next year or so. And if inflation starts to take off, the Fed is going to have to hike rates. And if the economy's growing, if inflation's at 2.5%, 3%, it goes above that 2%. If inflation's at 3%, they're going to have to hike. And them doing a 25 basis point hike, it's not a big deal. If inflation goes up to 3.5%, they'll do another hike. So as inflation rises, the Fed will hike rates, but they're going to stay behind the curve. They're going to let real rates continue to decline and stay strongly negative. So that is the fundamental argument for this potential catalyst. Now, there's also yield curve control, and that deals more with the with long term, like the 10-year and the 30-year bond yield. So it would be more focused on the 10-year yield. Now, that is another catalyst. I mean, that could potentially come before the Fed starts a new hiking cycle. I'm not really sure. It's something. I mean, I'll do another video on that after I've done a lot more research on it as to what the signal might be that yield curve control is coming. But I'm pretty confident that the Fed hiking rates is going to be an important signal for the market. And again, this seems counterintuitive, but when you focus on inflation and accelerating inflation, the Fed starting a new hiking cycle, it's just an admittance or a confirmation that inflation is starting to take off. And that could be the next catalyst for this market, the next major catalyst. I'm not saying that gold is going to go down or continue to correct or, be dead money for, another year or so before they hike rates. We don't know that. I mean, if we're looking at the market has now priced in the Fed funds futures. They've priced in a rate hike at the end of 2022. And I also saw something yesterday. The market has priced in a 12% chance of a rate hike in December of this year. I mean, a 12% chance, that's only 8 months away now. So if the data comes in really strong over the coming months, you're going to see a lot more talk about the Fed doing a rate hike sooner than has been expected. And another thing to point out, if we look at the 70s, the market was strong, and those big moves in gold we saw at the beginning of the 70s and then in 1976, those moves started, those bottoms, they started, and gold started moving up several months before the Fed actually started hiking rates again. I mean, the first time it looks like the beginning of 72 is when they started a new hiking cycle. So gold had already moved a lot by then. And then we saw it again in 76. That bottom looked to be, 3 months or so before the Fed started hiking. So it's just something to keep in mind. Gold, I mean, it could start to move 3 months before the Fed hikes, 6 months, 2 months. I mean, I don't know. But like I've already said, this is an important indicator to keep in mind. And that's my belief. If we see inflation accelerating, it's good for gold, and the Fed is going to be hiking. They're going to stay behind the curve. Then you're going to get gold coming out of this cup and handle over the next couple of years, exploding to much, much higher levels. So that was a lot to take in for one chart. I guess to dumb it all down to a couple sentences or a paragraph, the Fed hiking rates is going to be super bullish for this bull market, and it's going to mark a big catalyst, and it could confirm, because when it happens, you could already see gold moving higher. I hope this explanation helps you. I hope it was informational, educational, etc. Thank you for sitting through this. I really appreciate it. Leave me a comment. Let me know what you think. And I'll be back with another video for you guys in the days and weeks ahead. Thank you.